manufacturing. You can use that as your screen. We've had a lot of interest in the last 6 months around low carbon investing and low carbon indexes, which is on this slide. So we've actually been working with a major Nordic investor who has put money behind a fund run by Amundi, benchmarked to a low carbon index. So there's a lot of interest in the investment community right now around how to decarbonize your portfolio because of a couple of concerns. One is carbon regulation is evolving globally, and another concern is the stranded assets. So the potential for future investments by a company, particularly utilities and energy companies and resources companies, they may have invested in an asset that they can only say, for example, dig up the coal resources or extract the oil resources. They're planning to bring it online in about 15 years from now. But in 15 years from now, the global context for carbon policy and the energy markets will have rapidly shifted. So it's similar to, say, Kodak. Kodak was happily rolling along in their business strategy. They were very, very dominant in film production, and they did not anticipate how quick the switch to digital cameras would be. And they found that all of their assets, all of their IP and all of their investments that they'd made over the years were now worthless. It became a stranded asset. In the same way, there's a lot of investors in the global markets right now very concerned about the potential for stranded assets in energy markets related to carbon. So we've been, we've been working with investors on that. And what's very interesting is that using the research that we've produced is you don't have to sacrifice returns. I think that's one of the myths that we still see, particularly in Asia, particularly when we're talking to Asian investors and asset owners. They're very concerned about, I like the idea of ESG, but I don't want to sacrifice returns. My responsibility is to maximize returns for my members, for the pensioners, or for my clients, or for the government, if I'm a sovereign wealth fund, for example. And what our research has demonstrated is that it doesn't necessarily mean sacrificing returns. In fact, the tracking error for this low carbon index was optimized using our risk management tools internally at MSCI to minimize the tracking error and to make sure that it matched the benchmark very, very closely. However, it's got 50% less carbon emissions than the current benchmark, the mainstream current benchmark, and significantly less exposure to potential stranded assets. What we see with our emerging markets index is also very interesting. So we have our ratings and we have our controversies assessments for all of the companies on the MSCI Emerging Markets Index. And this is a particularly stark example of how investing in an ESG optimized portfolio doesn't necessarily mean somehow that you're making less money. So the red line indicates, everything right of the red line indicates when we launched the emerging markets ESG index. Before that, it's essentially theoretical backtesting, but we've had it for nearly 2 years now, and the performance has been extremely interesting and extremely impressive. And there are many reasons for this. Someone needs to do, very deep, I think, analysis into why this is the case for emerging markets. This outperformance among the ESG Emerging Markets Index compared to the Emerging Markets Index is much bigger than it is for developed markets. And we need to understand this better. My personal theories are that there is, where you see a company in an emerging market context being proactive around risk management, and investing in clean tech innovation and making sure that their people are satisfied and are retained and treated well, for example, that also correlates with just strong risk management in general, strong financial risk management, frugal way of running the company, and that makes a big difference in an emerging markets context. So those are some of our ESG indexes. This is for you. I know that I'm sure everyone's very interested in how the Thai companies are performing. These are the Thai constituents of the MSCI sustainability indexes. So these are the ones that meet a certain minimum ratings threshold and have no severe red flag controversies. These are only in alphabetical order, so it doesn't tell you anything about the weighting of these companies. What's the good news for Thailand is that more than 50% of the companies on the emerging markets index qualify for the sustainability index because of their strong ESG performance. So, what was the comment? Miss. Oh, okay. Yes. Yes, you could consider some marketing and branding changes. And actually, we've been working a lot with companies over the last year, just informing them when they're on the sustainability index, because we realise that companies also want to know, because they put out all of the sustainability reporting and information, and they don't actually hear a lot of information back necessarily about whether anyone's reading the information, whether investors are using it. And by letting them know that yes, they are on the sustainability index, that's actually helping the companies to know that someone's looking at this information, we should keep reporting it. And also they want to be able to talk to their investor relations teams want to be able to talk to their shareholders about how they've achieved this certain performance. So how am I for time? Am I 10? I'm okay? All right. Okay, good. So I wanted to also spend a little bit of time, I think for me this is the fun part of the presentation, moving away from all of that dry kind of what is happening in the market, and actually thinking about some of the environmental, social and governance issues and how in practice they might actually affect different types of companies. So I mentioned earlier the interest in low carbon investing, and a big reason for this interest in low carbon investing is because of the broader scientific research and economic projections that are being formulated right now by bodies such as the United Nations, the Intergovernmental Panel on Climate Change, and other bodies around how real and how big the impact of climate change is going to be. It's no longer a question of will it happen, will it not happen? It is happening according to the world's leading scientists. The question just is how much? How much is it going to happen? And so the conservative projections from the Intergovernmental Panel on Climate Change are that sea level rise related to climate change is going to be within about 30 to 60 centimetres. And the more aggressive or the more worst case scenario projections from the same body is that sea level rise could be up to 1 metre. And so this is obviously very concerning, and what we've, particularly for countries in Asia, where there's a lot of coastal regions with Asian countries, a lot of low-lying regions, and a lot of people are going to be affected by this. And so what we have done is released a report looking at which assets in which areas are actually the most exposed. We've done a massive mapping exercise globally, looking at US utilities, properties in Australia, etc. And for Asia, what we found was this, is that there's the majority actually of properties in Japan and in Hong Kong are exposed to some form of sea level rise, and they're also exposed to storm surge. So with climate change, you don't just get the sea level rise and the flooding that comes with that, you also get more violent and more frequent weather patterns that create storm surge issues. So similar to what you saw with Hurricane Katrina that shut down New York for a few weeks. We can expect these types of incidents to be more and more frequent. And so the majority of Japanese and Hong Kong properties are exposed. Obviously, the property markets are very, very important to the economies of those countries. And we were able to break it down to the individual REITs, the individual real estate investment companies and real estate management companies, and found that a company like Nippon Prologis REIT has 21% of its properties exposed to sea level rise and storm surge. That's a huge chunk for the company. In Hong Kong, we've got Henderson Land Development with 11% of its properties exposed. The majority of these are residential buildings, and then there's some mixed use as well. And then Sinoland Company has 9% of its properties exposed. So, this issue, if you're investing in property, and if you're a real estate management development company, you need to be mapping these issues in order to adequately plan your investments for the next 10 or so years, which is the time frame that you want to be investing in property. It's not a quarterly thing, it's not a yearly thing, it's a longer term time horizon, but it's very real, and it's very real for Asia. And this sea level rise projections that the Intergovernmental Panel on Climate Change has discussed, they're going to happen in my lifetime. My retirement is going to be affected by this. My children's retirement is definitely going to be affected, because it's all going to come into play by year 2100. So we've got the next 85 years to try and adapt to this circumstance. In another area where we've looked at the risk of what climate change is doing for governments, is we've also looked at infrastructure funding. And we've identified, by looking at countries that relative to their income peers still remain underinvested in infrastructure. And so a lot of these countries are now becoming a focus, particularly for organisations like the World Bank and the IFC, to lend, to create, to build more infrastructure. And there's a lot of interest among a lot of the institutional investors that we work with in infrastructure as an asset class, to diversify away from equity markets. The cash flows are stable, they're long-term, they're guaranteed. This is a very interesting topic for institutional investors. So we looked at which are the countries that are underinvested, and which are the countries that have stronger political governance, in order to identify where the opportunities may be for green infrastructure. So the infrastructure that needs to be built in these countries, in order for these countries to have low carbon economies moving towards year 2100 with sea level rise on the horizon, needs to be as green and as energy efficient as possible. And again, Thailand has been a real leader in creating the political environment for green investment. We're watching very carefully the carbon pilot trading. That's the pilot carbon trading, not the carbon pilot trading, the pilot carbon trading that's happening in this country. South Korea is a real leader in this area as well, creating a whole raft of policies that support low carbon economic growth. They're also launching a carbon trading scheme sometime in the first half of 2015. And so this, a lot of our investor clients, some of them are interested again in returns from green infrastructure. So they want to get right at the front of this green infrastructure curve for financial reasons. And then some of our investor clients are interested for values reasons. They want to be investing, they want to have positive social impact. Some of them actually have mandates to make sure that the money that they're investing has positive environmental and social impact. And they are actually willing to give a little bit on the return side in order to make sure that they're having this impact. So both of the different sets of investment interest are using this type of analysis to guide and inform their investment decisions. Korea, I've already mentioned. We're watching Korea very carefully around the introduction of their carbon trading scheme. What's very interesting about the carbon trading scheme is that when it was announced, it was projected to be a very aggressive carbon trading scheme, with the number of credits and the way that the caps work resulting in the highest actual per tonne carbon price globally. So this is higher than the price that you see in Europe, higher than the price that you see being applied in the carbon trading schemes in California, for example. And so that is really positioning Korea at the forefront of this green economic development curve. And then the way we analyse that, and the way our investors would like to understand carbon risk is, well, which are the companies that are more likely to be affected by this carbon trading development than others? So the chart on the right highlights which companies in which industries have a higher carbon intensity and therefore are going to actually incur direct costs, or they might actually be required to limit the amount of carbon that they're emitting into the atmosphere. So they will have direct incentives to become more efficient with their carbon and their growth. So again, with an issue like carbon, you're focused on the steel and chemicals companies and less interested in the banks and insurance companies. For banks and insurance companies, their risks are similar to this, their exposure to this issue is similar to other investors. They want to know that the carbon emissions of the companies that they're lending to, that the environmental performance of the companies that they're insuring is solid. And so we're talking to more and more to banks and insurance companies in the region as well about how we can help them with their primary due diligence on credit risk and on insurability because of these types of environmental reasons. So related again to carbon, somewhat related to carbon, but actually a separate and distinct issue is the pollution crisis. That's not just in China. Obviously, pollution is an issue throughout Asia. But I wanted to share with you a couple of photos I took while I lived and worked in Beijing. This is, it was wonderful to have clear days like we had on the left, and it was unfortunately all too often to have days like we have on the right. The same view taken from the same window from my office in Beijing, and what this is now causing is a lot of political concern around pollution, and encouragingly a lot of political action in China to address this issue, because this is really now become a growth issue for that country. If you can't, increasingly people on the ground in China are talking about if you can't enjoy life, what's the point of economic growth? If I'm going to get cancer, lung cancer from living in this city, I don't really care about having economic growth. So it's becoming, the political and economic and financial issues are very much aligned now in China. And what we looked at was the strengthening environmental pollution regulations. So last April, the Chinese government announced a massive overhaul of their environmental regulations, and they are to come into force this month in January 2015. And what those regulations did is remove the cap on potential fines that could be imposed on companies, to enable local community groups to actually sue companies and local governments to take them to court, to hold them accountable for lack of enforcement of environmental regulations or for environmental violations. And they actually enabled, the penalties under the new law include the ability to imprison certain company managers who don't comply with environmental law. So you see from all sides, you've got the pressure moving in the same direction. And what we did is then look at an analysis of, well, which of the companies in China are more likely to be negatively affected by the introduction of this law than others. And what we found was among state-owned enterprises, which is the red bar, compared to the blue bar, which is the non-state-owned enterprise companies in China, looking at the ones that are going to be potentially affected by an environmental law such as this because they're operating in mining industries or chemicals or heavy textiles manufacturing, so they have a heavy environmental impact. Looking at those companies, we said, okay, we can actually see, based on our data sets of hundreds of companies and hundreds of violation incidents, that SOEs tend to be the repeat offenders, state-owned enterprises tend to be the repeat offenders. And in fact, the fines imposed tend to be a lot higher for state-owned enterprises as well on an adjusted market cap basis. So, and we also know, because we're China watchers, we have people on the ground there, we also know that these types of laws, which do have that political motivation, are much more likely to come down quicker and harder on state-owned enterprises, because state-owned enterprises are meant to be carrying out government policy. And so we then looked at which of the different state-owned enterprises individually that have the highest record of violations, which is on the x-axis. So we've got Huaneng Power and Datong Power have the largest number of environmental regulatory violations versus the actual value of penalties. So we know that there's a lot of violations happening, but they're not all being penalised. And we know that there are some violations that are being penalised, which is represented in the y-axis. So we identified this handful of companies as the ones that have been the most frequent. They're also state-owned, and they're more likely to be affected by the introduction of such a law, environmental law. And PetroChina being a very big outlier example, and perhaps was made a lesson of for other companies, because at the end of 2013, they had a record-breaking fine imposed on them, 850 billion yuan, I think million. 850 million yuan fine was imposed. for refusing to comply with environmental law, and it was imposed by a court because the company, a certain subsidiary of the company, actually had to be taken to court and asked to pay compensation over and over again, and they kept refusing, to the point where the court actually froze their bank accounts and said, no more, pay the fine, and you can't actually operate your business anymore because you can no longer pollute the environment around this particular oil extraction site. The community is suffering. So that was really a warning signal to a lot of other state-owned enterprises, and since then we've seen other fines imposed, and we expect that trend to continue. So moving on to governance. So I know that governance is an issue that a lot of investors outside of Asia ask me about and want to know about Asian companies. I remember one of my very first client meetings I had while I worked at MSCI. I was with an investor who was very invested in Asia, and we spent about an hour going through a report we just released about China and all of the different ESG issues that are going to become material for companies. And then at the end, she said, I'm not interested in China actually because it's too complicated. As Chris mentioned earlier, it's too complicated and there's too much ESG risk. I want to know about the rest of Asia, and I want to know about corporate governance in particular in the rest of Asia. She said, I know that the corporate governance is different, but I don't know how it's different, and I don't understand it, and I want to understand it. And so we've invested in the last year in purchasing, acquiring another company that has very, very deep governance expertise, and we're integrating them into our business. And we're about to release this quarter a whole new suite of governance products integrated into our rating. But the reason I raise this is because governance, the characteristics of board members, is a hot topic in a lot of markets internationally, and this informs the types of questions and the types of things that global investors think about when they come into an emerging market and they want to have a discussion about board governance and governance of the company. So the characteristics of board members is an issue that we've highlighted, one in the area of gender diversity, and one in the area of the actual industry expertise, the actual skills of the board members. And what we found is that in both cases, that boards that are more diverse, at least on gender, that have at least one female director, have shown higher return on equity than those that have none. So this is not causation, it's just a correlation from what we've seen at the moment, but it's interesting. And then we also see, as you would expect, more board members with relevant industry expertise also deliver more return on equity than having many board members who are sitting on the board without much relevant industry expertise. And what we are seeing right now is a lot of scrutiny over certain Asian markets by global investors as to why this gender diversity statistic remains so low. In particular, markets like Japan and South Korea are of great focus for investors who come from Europe, where they're used to much higher levels of female representation on the board. So, for example, a headline that I saw just last week was comparing Norway with an average of 35% of women sitting on boards compared to Japan, which has only 3.1%. And even this type of scrutiny is actually starting to spark a discussion on the ground. One of the researchers in my team has been sitting on a Senate committee in Japan around board diversity, and they're trying to think of strategies about how this board diversity can be improved in Japan, seriously. But it's very, very slow to move. What we can see with Thailand is that Thailand is definitely above the emerging markets average on gender diversity, which is fantastic, and way ahead of countries like Taiwan and South Korea, for example. So interesting, again, another point to raise when you're talking about the investability of this market. And I think that reflects, again, those years of investment that have been made on corporate governance. Another interesting correlation that we've seen is that the greater number of women sitting on boards historically has been associated with less governance controversies. So less fraud, less anti-competitive behaviour, less graft issues. So on the left-hand side, what you see is you see the companies that have less women on the board relative to their country average tending to have a higher average level of governance controversy, and on the right you see the companies that are ahead of their country peers. Okay, so for example, when you're looking at Japan, if we've got a company that has 10% of women on the board, we want to still reward that company, so we put them in that bracket and then looked at their controversies then. So we're not saying just globally that all Japanese companies, because they have a very low rate of women on the board, therefore have more controversies. It's relative to the country context, because governance is, yeah. So did you want to ask something?
Yeah, I have two observations. When you talk about women on boards or female, I think it's not just the gender that you were born to, because we can change our mind later, right? So it might reflect a man with a woman thinking character might be in this way. Just like Warren Buffett, he is a man, but he is using his stock like a female when investing. And secondly, I think if there are too many women, it's not nice to work.
Right, absolutely. I mean, well, this is where, again, at the early stages of trying to demonstrate and prove these correlations, but it's really about the idea of diversity. And most of the academic literature says, yes, it's not about your physical gender, but because people with physical genders tend to have different types of communication or management styles, bringing more of those diverse management styles into the boardroom is positive. You see the same problem from many different angles, and that's better risk management. I think most investors are not particularly interested in seeing quotas introduced, and a lot of very senior women that I know are not interested in being appointed to a board because of some quota either. In Norway, they've introduced quotas. Most other markets have not. But what regulators are doing is that they're using the threat of introducing quotas to get companies to move a bit faster on gender diversity and board diversity. So it's not all about risk. It's not all a doom and gloom story, particularly on the social area. And this is my final point. Particularly in the social area, we see a lot of opportunities for companies in emerging markets. And one of the areas that we look at for financial services companies is the extent to which they're tapping into new markets through product innovation, product adaptation, allowing individuals, both retail customers as well as small to medium enterprises, which have traditionally been excluded from capital markets and from larger debt markets, and allowing those underserved market segments to access financial services. And this is very, very important for countries like Thailand and for other Southeast Asian nations. And what we see in countries like Thailand is a lot of investment on the part of banks in this area, particularly over the last 3 years, compared to a lot of their developed market peers, where their developed market peers are kind of companies such as Barclays, for example, or RBS. They might tiptoe with a little bit of microfinance into Indonesia, or experiment with a little bit of microfinance in Vietnam, but they're not on the ground and they're not able to adapt their products as effectively as the local players are. And so what we see is stronger growth in small to medium enterprise lending. On the chart on the left highlights that. Stronger growth in terms of the actual representation in the lending portfolio, and the rate of growth is faster for emerging markets economies, with a real focus on Southeast Asia as well. So this is what an analysis would look like for on some of these topics for one of the companies that we research, Siam Commercial Bank, SCB. This is the company I like to talk about when I talk to investors globally about emerging markets, and isn't the disclosure really poor in emerging markets, and aren't the ratings really, really bad in emerging markets because emerging markets companies don't manage these issues? And these are the types of preconceptions that global investors have about emerging markets. And I always pull out this company and I say, well, actually, this is a very strong example of a company that has shown year-on-year improvement. This was a company that, when we first started researching it in 2011, was B. It was rated B, so it's quite low on the rating scale. But in the last 3 years, it has rapidly improved to an A on our rating scale. And when it comes to the management of people, that's one of the strategic issues that we look at for banks and financial services companies. We look at the extent to which they invest in the training of high-quality talent, their ability to retain high-quality talent, which is very important for financial services. This company ranks among the best among global peers. It's in the top quartile, and that's compared to US banks, Australian banks, etc. So, you know, there's lots of good news stories in emerging markets as well, and we're trying to highlight those as well as the risks for our investors.